Are you prepared for the looming storm in the global housing market? We have all heard the news that the average 30-year mortgage rate in the United States has just hit a staggering 7.6%, the highest since December 2000. But what if I told you that this isn't just an US issue, but a worldwide concern? The answer lies in the history of housing bubbles, inflation, and a potentially disastrous chain of events that could be on the horizon, affecting economies around the globe. You might have seen countless charts showing housing prices over the years, but there's a crucial aspect often overlooked: inflation. For instance, if someone bought a house for $200,000 in the year 2000, adjusting for inflation, that same house would be worth about $356,000 today. To understand the real extent of a housing bubble, we must look at inflation-adjusted home prices, which the inflation-adjusted Case-Shiller Index provides. By studying this chart, we can see that real home prices have exceeded the levels of the 2008 housing bubble, which was considered monumental. However, it's clear that we have ventured into uncharted territory since around 2012. But what leads us to believe that a crash is imminent, not just in the United States, but globally? To answer this, we need to look at the role of interest rates worldwide. After the 2008 bubble, central banks around the world continued to keep rates at record lows, setting the stage for a new bubble in various countries. The real price of homes, when adjusted for inflation, surged dramatically, and historically, such rapid increases have led to crashes not only in the United States but in other countries as well. The housing market isn't just a local or national phenomenon, it's a vital component of the global economy. The recent surge in mortgage rates in the United States isn't an isolated event, but rather a symptom of a broader issue that has implications around the world. The past 2 decades have seen a remarkable rise in the global real estate values, characterized by surging prices, record low interest rates, and a frenzied demand for housing. In many parts of the world, from Europe to Asia and beyond, the story has been strikingly similar. Real estate has been viewed as a safe haven for investors seeking shelter from economic uncertainties, and this global appetite for property has driven prices to unprecedented levels. However, the seemingly endless ascent has raised concerns. The rampant escalation of housing prices in multiple countries is no coincidence. It's a reflection of interconnected financial systems and a common reliance on low interest rates as a means to stimulate economic growth. But what goes up must eventually come down. The consequences of a global housing market crash could be far-reaching, affecting individuals, economies, and financial institutions in every corner of the world. Stay with us as we explore these intricate interconnections and their potential impact on the global stage. If you are not convinced by historical trends, there is one more piece of evidence that should seal the deal. It's all tied to the 10-year treasury note and the yield curve. An inverted yield curve is a glaring sign of an impending recession. Every time this has happened in the past, a recession has followed shortly after. The current inversion is even deeper than before, making it even more ominous. In numerous countries, from Germany to Japan and beyond, yield curves are exhibiting signs of inversion. This widespread inversion suggests that the global economic landscape is becoming increasingly uncertain. Traditionally, a healthy yield curve has a positive slope, reflecting the idea that longer-term investments carry a higher return. However, when short-term rates surpass long-term rates, it signals investor concern about the immediate future. But here's the kicker. It's not when the curve inverts that we should be worried, but when it returns to positive territory. That's when the real pain begins. Central banks are pushing rates as far as they can, but the bond market seems to be challenging their efforts. This is where the crisis may brew, and it could break the entire global housing market. Recessions lead to a decline in global trade, affecting not just one country, but economies interconnected through international commerce. Export-oriented nations may experience a decline in demand, leading to layoffs and reduced economic growth. The stock markets around the world may face turmoil as investors seek safety in times of uncertainty. stock values can plummet, impacting individual portfolios and retirement funds. Currency values can fluctuate significantly during a global economic downturn. Exchange rates can experience volatility, affecting the purchasing power of consumers and the cost of international transactions. Central banks may respond to economic crisis by raising interest rates, which can have a cascading effect on mortgage rates, borrowing costs, and the real estate market. This could intensify the housing market's downward spiral. Governments often respond to recession by injecting funds into the economy through stimulus packages. While these measures can mitigate the economic fallout, they also contribute to rising national debts, which have long-term implications for future generations. This impending crisis could be triggered by a complete breakdown of the housing market, and when it happens, it will make previous bubbles pale in comparison, impacting economies worldwide. As the housing market collapses, homeowners with adjustable rate mortgages and those looking to refinance could face the struggle of higher monthly mortgage payments, potentially leading to more foreclosures. For real estate investors, the devaluation of their properties could leave them owing more than their investments are worth. In conclusion, a global housing market crash is looming on the horizon, and it's crucial to be prepared. The factors at play, from soaring mortgage rates to an inverted yield curve, indicate that a severe economic downturn is looming on our heads, affecting economies around the world. Stay tuned for more insights on WealthWiser, and don't forget to like and subscribe to support the channel. Your support means a lot to us, and we appreciate you being a part of our global community. See you in the next video. Until then, stay WealthWiser.